Episode 230. Today, we are going to be talking about record prices, Fed cuts, affordability crisis, and there's a lot more. So you're going to want to listen to this and tune in right freaking now.
Who sings that Peaches song?
The powders, like this powder, that powder.
I know, I
I'm
saw
on
you.
it.
Saw you a little baggy.
Yeah.
Doesn't sound like you're on the right powder, though.
Not yet. Yeah. All right. Welcome back. Episode 230. Today, we're going to do a little bit of a different format. You're going to like the format because it's the greatest format you've ever heard. What does that sound like?
You didn't do an accent.
Well, I don't know how to do that accent.
I can't do it either.
Yeah,
Shane Gillis has got it down.
Yeah. But today, episode 230, we're going to talk about the record prices. We're going to talk about Fed cuts. Is it happening or not? Affordability crisis, and so much more that you're going to just be blown away. And you want to go and support our sponsors first, because if it weren't for them, then this show would not exist anymore.
Nope.
We only do it for them.
Yeah.
Yeah. So you want to go support Mortgage Mike. He's giving that Mortgage Mike stamp of approval, loans left and right. He's so busy right now. There's no affordability crisis in his world because he'll just give you a loan. Yeah. Got $199. He's got you. Bad credit, doesn't matter. He stamps it.
You want to know, speaking of that, we had, I gotten 3 people over to Old Mortgage Mike in the past 7 days. One of them's already out looking. The other one we're still working with, but one, came back in. She's got some work to do. And one of the things that I thought was really great was, Mortgage Mike has got kind of this mortgage kind of questionnaire calculator thing that he was able to send over to her that gave her a lot of clarity for my conversation with her. Cause I got to admit, I still do struggle with what to do with the people who need that kind of care and that time, where to put them. But he had a good game plan. So now she's got a 12-month game plan on how to get on track.
Get with him. MMG. So Mortgage Mike. So mmgloans.com. Tell them the guys from the Only Real Estate Podcast worth listening to sent you over there. And then at the same time, you need to get a home warranty. Air conditionings are going out. Mine's out
Left and right.
Yep. They're out. It's too hot. Then the next 2 weeks is cooler. Maybe it'll be easier on my air conditioning and my electricity bill. But Theron Smith can help you. He can help you lower that electricity bill because he's going to give you that armadillo protection, that hard shell protection on your house. Just go to armadillo.1/Tor, TORE, and get that hard shell warranty on your house. And then when it comes to property management here in Dallas Fort Worth, Dana Wynn at Homeward DFW, she'll take care of your property the way she takes care of her own.
Yep.
And then Tor Studios, Jesse over here. Jesse's got his own camera set up. It looks like an old school video camera from here.
It does.
So we got the Jesse Cam going live. TorStudios.com. That website doesn't work, so just go take a look at it.
I came in and shot some content with Victoria the other day, and I ran it through Opus and was listening to it back. The new mic sounds sweet.
They sound so
No, I love it. I like the
super
arm.
silky smooth.
I want this mic and arm in my new office, in my house.
Yeah.
Yeah.
I love it. Jesse can probably tell you where to get it.
Well, yeah. He has an Amazon wish list.
I forgot that Nick had moved, and I was all
I haven't moved.
Oh, well, his background has changed.
Yeah.
Something's changed about his
Well,
background.
that background is,
where are you?
No. That was because I was doing it from my kitchen table because the kids went back to school and then somehow they came back home because they all have pneumonia.
Yeah.
Oh.
Pneumonia is out there to get everyone.
Everybody
Someone
came
else
home early on Monday.
Yeah, we had pneumonia, and so it's I was doing that from the kitchen table because
Can you catch pneumonia from somebody else? Is that like a thing?
I think you catch the other thing that leads to pneumonia.
Oh, wasn't
I don't know.
didn't the Backer's daughter have pneumonia?
Yes, she
Yeah.
did. Yeah, she was in the hospital for a couple of days.
I didn't know any of this was going on.
I thought pneumonia was a cold thing, not
I
in
think
the
it's
summer.
cold and
I think
no.
it's a lung thing.
What am I
but
thinking of that you get when you're cold?
The chills.
the colds.
Oh, yeah. Okay.
Yeah.
Yeah, that's fair.
Get a cold?
So let's break down. By the way, leave us a 5-star review.
Please.
Go to
Good
all
thing
the
this isn't a show
Spotify
about
channels.
doctors.
Subscribe.
Yeah, we would chat GPT it. Be like, what does this look like? Oh shit.
Jesse, do you want to
Got AIDS.
You want to live stream the NVIDIA earnings call in the background just to add another element
Right.
of surprise to the
My
show
dumb
today?
brain looked at Jesse at lunch today, and I said, "Hey, dude, I've been hearing this name a lot lately, but I don't know what they do." And he goes, "What?" And I go, "What's NVIDIA?" You had to explain it to
Nobody
me.
knows.
Yeah.
I didn't know what
I mean,
they
I don't
did or
think
what
we
their
actually
job
do
was.
know.
No, they just make AI chips. They used to
make
be.
chips.
They were a video game.
Potato chips.
They made
corn
the
chips.
3D or the graphics card
Graphics
for video
cards.
game
They still make 'em.
computers, but they're well known now for AI chips.
Correct.
Yes, that's their bread and butter now. But they're
Bread and butter
graphics
chips.
card
So good.
producer before a lot of hardware stuff like
Yeah.
that.
Yeah, they're overpriced. The market's going to tank them. They're coming down.
I'm
Didn't
more
like-
of a Taiwan superconductor kind of guy.
Oh
myself,
yeah, you
but-
would just keep outsourcing
Yeah.
it, Jesse.
Yep.
Don't keep it in the USA.
I lost myself when I asked my question, so I don't know what's happening.
Yeah. So, all right, today we're going to talk about affordability. So let's dive into that. We'll get into Fed cuts. That is it going to happen or not happen? And if it does happen, how much is it going to be? What's the impact on it? As well as there's going to be some more to that, but record-breaking home prices and affordability challenges. And look, this show is recorded here in Dallas. So if you're listening to and you're not in the Dallas-Fort Worth area, we are going to kind of compare this to the national home prices right now. So as of June 2024, the national median home sales price is $426,900. Right, that's marking a record high.
Seems high.
And
very high,
which is crazy because you start looking at this and we have felt here in Dallas some softening on prices.
Mhm.
But the Dallas Fort Worth median home price is 405. So if you look at it nationally versus here, we're definitely more affordable.
The crazy thing is, it notes that the year-to-year change is slightly down from last year. So why it's a national high, DFW prices dipped probably a very small amount from last year, though, which is
Yeah, I mean, we were still last year when other areas were they felt pain. We were like, oh, the market's still pretty
we're
strong.
fine.
I will say that, something that I have shared within our sales and team organization is that here in Dallas, nationally, a balanced market typically is 6 months, right, Brian? Right,
That's what
Matt?
they say.
Right, that's what they say. And we don't know who they are.
they at the international discussion of real estate level.
Yes.
Just they are just other people saying it.
Yeah.
And
And
enough of them saying it.
what I found here is that I believe that 4 months level of real estate is kind of a balanced market. Anything over that, we start tipping into more of that buyer's market because we have more single family pre-owned homes on the market. The last time we were at this level was 2003.
Yeah.
Right. You go back to 2008 and that great recession when homes were on the market, they weren't selling. We still technically, if you looked at it just in the Dallas-Fort Worth area and you just took single family as a whole, we were in a seller's market if we were taking that 6 months balanced market.
I think one of the ways to determine it, and this obviously you have to be doing this for a little bit to feel the trends, but like I've been able to tell with this one specifically that buyers have more leverage, right? They have leverage around seller concessions. They have leverage around other negotiation points. I've heard many agents say, my seller already came down quite a bit, and then they came back in inspections and asked for more. Like that's the conversation. So when people ask, or you're evaluating your market on what does a buyer's market look like, it's not always about the numbers because we have micro markets here too that are much more busy than other places in every aspect. So I think that's the hardest thing for agents sometimes to determine what does a buyer's market feel like. It feels like your buyer having leverage, right? And if you've been doing this even for 4 years, you should know the difference because buyers are getting their asses kicked for a long time.
Well, I mean, we're trending. It's not on this list, but I think we're trending towards 4.1 million home sales again this year.
Yeah.
Isn't it really wonder why? You can look at these variables here. There are 3 variables that determine affordability. It's the price of the asset that you're buying, the rate at which you're borrowing the money to buy it, and how much money you make at your job. One of those has not increased. The other 2 have.
Yeah.
So even though rates have come down from their highs of October 2023, they're still a little higher than the historical average. Hopefully that's going to change soon, and we'll get into that. It's a fundamental math problem, right? If your price point is that much higher than it used to be, and people aren't making that much more money than they used to, it's going to be a difficult time to get your home sold. Inventory is going to pick up. The music's going to stop. I don't know where the single family housing market goes from here, in the sense that we tend to talk about things from an agent perspective as we're in this part of the cycle or this part of the phase. I don't actually believe that's the case anymore. I don't believe that we're in any part of the normal housing market cycle. I believe we're in completely uncharted territory. And the reality is, I think it might take years to unwind what we've done to the market and what the new sense of normal looks like. It could take a decade. That's not to be doom and gloom. If you're out there working, like, people are still going to need to buy and sell homes. 4.1 million people is still a lot. So the industry might look different moving forward. This could actually be one of the best things that happens long-term for the industry, because the people that will really thrive in this industry are the professionals, the people that are really, really getting it done right. If you had everybody and their brothers suing one another, you'd have a lot more people going to law school, right? It doesn't happen as often as you might think. So there are fewer lawyers out there. That may happen with the real estate market as well. I just want to be really open about the fact that I don't think we're in any part of the normal cycle, and I don't think that there's any clear path forward to get housing back to any affordable level.
Well, I think affordability is we don't know what the definition of that is, right? Affordability to you is different than affordability to me. It's different than you, Matt, in terms of, if we look at the how much money one person needs to make in order to say that it's affordable. And by the way, we'll go over that here in a second, but we're the uncharted territories that we're in. We're now writing the new norm, right? So we are now in the midst of engraving that new normalcy into this marketplace to be able to go back and say, all right, Mr. and Mrs. Seller, Mr. and Mrs. Buyer, this is typically what we could expect during this, right? It used to be, all right, you get past July, August here in Dallas-Fort Worth typically slows down. September's dead, October okay-ish, and then November and December start picking up. But that's, because we're getting, back into those holiday months and people are trying to make moves by year end. And then January typically sucks. February, we have an increase. March, April, May, and June are have the uptick swing on sales numbers. And, I think something to really kind of analyze and look at is that projected transactions at 4.1 is higher than what we thought it was going to be. We originally were coming in at 3.9 to 4, which 3.8 to 3.9, maybe 4, which would have been on one of the lowest that we've seen, because even during the Great Recession, we were at I believe a 4 million.
Yeah.
At 4 million.
Pound for pound, it would have been by far the lowest, because population has increased since the Great Recession. So it would have been per capita like the lowest in recorded history or something like that.
Yes.
Pretty close.
Yeah. And so if we were to break this down, right, and say, all right, the median household income, nationally we don't really have that. But right here, we're looking at, in 2022, the median household income in Dallas-Fort Worth is around $83,000.
Yeah. It hasn't, I can't imagine it's changed much.
No. And then they're saying, look, income required for a home purchase in DFW, residents need to make more than $116,000 to buy a home.
Yeah. So if the national average is higher than DFW and the national median income is lower than DFW,
yes,
than what you would need to buy in DFW, there's a big gap there.
Let me ask you this, though. Like, when we start to look at all this, and I mean, Matt, with you sending deals over to DeBacker, right now, you've been super busy lately. How many of those clients do you believe make more than $116,000?
Probably not tons, just because I know the percentage of people who make over that in the country isn't a lot. So I assume it's got to be the same. Look, people are optimistic. I don't think their expectations are unrealistic. I had conversations with two separate people today that, as I was going through my kind of LP mama conversation with them, it kind of very clearly said, if I had an interest rate somewhere in the mid 5s, I'm good. And I think that's going to be relatively attainable here in the next couple of months. When you talk about the higher inventory conditions, the concessions that sellers are making in some of these cases, when you put that towards buy downs, if we end up having the rate, decrease that they're saying in September, I think those people are in a position to be able to do that in that November, December month that you're talking about, right?
Yeah. I do want to talk about Fed rate here in a second, but as we look into this, I will say that I know a lot of clients buying houses right now don't make 116. They're less than that.
Yeah.
And so when as real estate agents, we tend to look at these stats and they can be discouraging. And then as a future home buyer, you look at them and they're definitely discouraging, right? You look at this and you're like, I don't follow into any of these categories, right? Like, I don't make 116. I can't afford a house then. And what we are seeing is that you're taking the averages, obviously, or the median of this, and obviously there's a high side and a low side of it to end up landing where we are here in the middle of this. But a lot of our clients are finding ways to get into houses. Some of them are getting gifts from parents and family members. That's great. If that's not an option, there's some that are scrimping and saving up in order to put a down payment down. Right. And some are starting to realize that, they can go a little bit further out. They're finding ways to get into homes so that they can put their roots down and start building equity into their house. And they're not looking at this at the very moment and saying, I believe that there's a massive crash coming. I'm not hearing that talk as much.
Both of these teams have really great systems set up for their agents to be able to call specific opportunities. And I have been focused a lot on people who are coming back and looking at listing alerts, which is buyer activity. They come back and look at the homes on the market. And I'm calling about 300 of them a day and talking on average about 10%, about 30 of them. And I will tell you, nobody's really expecting home prices to come down. They're not telling me like, and I've heard this in my career where buyers will be like, I'm just going to wait for the market to crash. Nobody's anticipating that happen. They're realistic about the market they're in. And there is some kind of urgency towards not getting further behind. Like they don't want to miss out on future equity like a lot of people feel like with this massive run up since COVID. And I feel that a lot more in those buyer conversations than anything else.
I'll play devil's advocate here and meet you guys in the middle. Prices absolutely have to come down. Now, understand that there's a big difference between a crash and prices coming down.
Sure.
A massive difference, right? We tend to look at things through the scope of the most recent crash in any part of the economy that we're in. So the most recent one will be the Great Recession. A fundamentally flawed and fraudulent banking system brought the single family housing market down. You had too many people qualify for loans. They had no idea what they were doing, what they were borrowing. And it was all feeding this money market machine. And a lot of people made a lot of money, knew what they were doing, knew that it would all come crashing down, and had a pretty good sense that the government would bail them out. That's not what's happening here. When we're talking about a crash, usually the crash implicates that there's some sort of fundamental flaw in the system. I don't really believe that there's necessarily a fundamental flaw in the system. We had a huge run up in prices during COVID. We made a conscious decision as a government, the Federal Reserve, to raise rates really fast to stave off inflation. That has caused more problems on the lending side. Here's some examples that you guys just gave. So we're not feeling this yet in the market. Some examples you guys just gave. People are finding ways to buy homes, right? And the first thing you just said is they're borrowing gift money. Okay, so that's equity that's out there right now. That will run out. It absolutely will. There are only so many people that will be able to borrow so much money from family members, parents, things like that. They're getting interest rate buy downs. Okay, so that's another equity play. That means if you give me a fee for money now, I will reduce the rate for a small period of time at which you're borrowing it from me. That doesn't change the price of the asset. That doesn't change the amount of money that you're borrowing from me. And it doesn't change the amount of money that you make at your job. So that is a temporary fix.
No,
right?
It could be long-term. It could be a permanent fix.
It could be.
Right?
I
Yeah.
have to pay substantially more for that.
Sure. I would love to know a percentage, and I agree with you. I'd love to know a percentage that of those buyers taking advantage of an interest rate buy down. How many is it a permanent buy down versus how many was like a
I
versus a
would
2-1
say,
or 3?
I would say more than don't quote me on this. I don't want to put, my gut tells me more than 80% are temporary buy downs.
It seems like
it is like 5 to 10 times the cost to do a permanent buy down. So again, that's an affordability problem. If I have to buy down the rate and it costs me a substantial amount of money, I probably can't afford that if I can't afford the payment at the higher rate. So it's a quandary there, right? And wages have been stagnant. If anything, wages are going down right now because unemployment has gone up. We just had I don't know if you guys, I don't know why this is not headline news. Every one of our job estimates this year was wrong.
Well, I was going to bring that up. It was going to be, well, not even the first one. Here's the problem that I have. And I was at a MCA dad's event last Saturday, and we were kind of talking about this, is that, you know what no one talks about is the job revisions report, where it got marked down by 800,000 jobs. And it's like, the news has already flashed it, so the news doesn't pick that back up at a high level.
Boom, and then it's gone.
Yeah.
We were supposedly have added 2.9 million non-farm payrolls this year. It actually got revised down to 2.1. Unemployed. Do you understand what a substantial number that is when it comes to terms of employment or unemployment? It's much higher. Unemployment is much higher than we were advertising before. And so when unemployment is high, it's very simple. More people need jobs, and there are more people out there that will do it for less so that they'll be employed. So wages come down. It's very simple. So prices have gone up a lot. Rates have gone up a lot. Rates have come down a little bit. All the things that are getting people into homes right now that we're talking about are essentially workarounds to the affordability problem. Now, I don't want to say this to sound doom and gloom. It will be a good thing if prices come down. It will spur buying activity.
Absolutely.
When things go on sale,
Yeah.
people buy more of them. So this is not like doom and gloom for real estate agents. We're so brainwashed and conditioned to just preach like up, up, up. You're crazy if you never buy a house. It's always going to go up. Even if you bought 2 years ago and your value drops a little bit, if you are buying a home as an investment, your stock portfolio does not always go up. I promise you. But if you try to time the market perfectly, you're pretty much always going to lose. And so
Can I interrupt you real
please.
quick? So I just unofficial stat, but by Mortgage Mike. So I just asked him what percentage permanent versus temporary. You know, he said 90 to 95% is permanent.
99 from his
90 to 95% of the interest rate buy downs he's doing, the buyers are choosing permanent buy down loans.
And how much more are those costing?
That's a great question, but
Real time.
but at the same time, you know, we're getting that from, again, Mortgage Mike, who's doing this. He's in that side of the business.
No, that's really interesting.
And I would, again, most consumers, most buyers, I would venture to I would go on a very far limb that they're going to choose the permanent versus the temporary.
If they can
because
afford
the
it,
temporary
sure.
is very similar to an ARM, and we've heard about, you know, they still, some people have PTSD about the ARM loans, for that. So, you know, the good news is that we're seeing permanent versus the other side. The flip flop would be, all right, 2-1 buy downs, meaning they would get this temporary rate for 2 years, right? This one-time temporary buy down for 2 years, and then that starts to come due and adjust upwards. Then you know, we're looking at a potential problem on the horizon that they could no longer afford it.
Yeah, it's that's interesting. I would wonder. I would definitely love to know how much more a permanent buy down is costing, because that's interesting. Again, if you have an affordability problem, you'll find a way to solve it. You'll make a market for it. So maybe because so many people were choosing adjustable rates in the beginning, or temporary buy downs in the beginning because they were cheaper, than the price of permanent buy downs had to come down, which is an interesting caveat to this. We'll always find ways to get deals done. The point I'm trying to make is that I don't want agents to think that because prices do need to come down, and by the way, to create a more balanced market long term, either wages need to go up or prices need to come down. It's very, very simple. Unless everyone in America is willing to radically adjust their quality of life.
I don't think that's happening.
It's not a bad thing for the market. If you were to buy a house and for the first 3 years, the price of that house or the value of that house declined by 5 or 6%, if you plan on living there for 5 to 10 years, you're not making a bad investment.
Yeah.
We have this mindset of like, I'm going to wait for the crash. My whole point around this is prices probably will come down. There won't be a crash. You should always buy a home when it's right for you. Don't try to time the market.
No, 100%. And you know, I kind of look at this too, you know, kind of one of two ways. And the first way is saying that, let's say that we don't see this massive drop in prices, right? We see this more of a stabilization in prices, that we don't continue to go up. So let's say we stay at the 426 or whatever we said it was earlier in Dallas, and we stay there over 12-month period. Does income maybe catch up? Because the way that I look at this, this is an interesting stat. In Dallas, the share of households making between $100,000 to $150,000 who owned a home or who owned homes dropped from 70% in 2011 to 51% in 2021. Right? So we lost, you know, out of that, it was a drop in 19% of homeowners, families who make $100,000 to $150,000, that they no longer, 19% less of those families own houses.
So that's a really good point. So I want to speak to two things there. One, what you just said already happened last year. Prices did not increase from 2023 to 2024.
Correct.
In fact, in most major MSAs, they drop by a couple percentage points. So I'm not speaking crazy when I'm saying prices are going to come down. They are in a lot of areas. Inventory is coming up. Prices are going to have to come down. What is an interesting perspective on what you just said as well is we have this whole other component to the market that we're really not talking about at all right now. And I have a feeling that it might have played into that stat a little bit. There is an enormous amount of people, millions upon millions of Americans, that have 90 or more % of their entire net worth tied up in their single family residence, and they are approaching retirement age. And they are going to sell those homes for the most part, because that is what's going to unlock the only source of wealth that is outside of their 401k, which they probably have very little faith in right now. And by the way, it's probably about to take another hit over the next couple of years as well. And so when you have that much pent up inventory that needs to come on the market, you're going to have to see a decrease in prices. And I'm wondering how many of the people that were making $100,000 to $150,000 households, those people felt like it was the right time to sell and not purchase again, meaning that was their final home. They're now turning into renters, and they feel like if they unlock that wealth that they had tied up in their single family residence, they could move to a really nice townhome or something that they're renting now, and they're not becoming homeowners again. That's why you see such a significant drop.
Yeah, it's there's going to be a decent, maybe a decent percentage, maybe majority, or even if we're a little bit under that, it's still going to be that, what we have a crisis on at this moment, right? So if you're kind of picking up on what Brian just put down on that, is that the opportunity is as a real estate professional is to start, in my opinion, I'd start marketing to the future retirees to start building up that future inventory list. And then
huge market.
Yeah, huge.
The rate at which baby boomers bought their homes dwarfs the rate at which Gen Z and millennials are buying homes. And so you're going to have way more people moving out than first-time home buyers moving in. Your opportunity on the listing side is way bigger than on the first-time home buyer side there.
Correct. And so, I look at it if we take the baby boomer retirees out of this and say, all right, those making 100 to 150,000, we have that drop in home ownership. There's definitely more, and we listen, you may have heard this, Brian, on the All In podcast, is we have in today's society, we now value comfort and convenience and more personal time than work time in our life. And so people don't want to give up the luxury items like a Starbucks every day. Mm-hmm. They don't want to give up their tanning membership, their gym membership, their massages, whatever it is.
Convenience is making people broke, though. I was talking to the boys about this. Is like the fact that people will pay twice as much to have something Grubhub to them for it to taste half as good.
Yeah.
It is something that I've done that now I look back on, I'm like, what an insane waste of money that is.
Right. But we now see this. It's the same reason why when we talk trash about Open Door or OfferPad or some of these iBuyer programs, and like, this is ridiculous. And people take convenience over anything else. Yeah. Right. People don't want to do the hard work in order to make a little bit more money.
And you talk next week about the super app that Zillow's coming out with.
Oh yeah. Well, it's an interesting conversation. We could go down a whole rabbit hole here, but one of the things that gets lost in these statistics, we tend to look at like I said, the three things that go into affordability: asset price, interest rate, and wages. One of the things that is a little bit more of an intangible is how those wages are allocated towards quality of life now versus any other period of time. Meaning, we always talk about, our parents growing up in the 50s or grandparents, and buying their first home on a waitress's salary or whatever it was, one of the things that tends to get lost is the ease and convenience by which we are able to spend what would otherwise potentially become investable funds or disposable income is mind-numbing to the point that it's almost predatory in our society nowadays. We don't have to rattle off statistics, but the level of financial ineptitude in this country, I think, has been very well documented. We are not very smart with our money as a society. The majority of people only invest through their 401k or pension fund, if at all, right? And over time, it's only become easier and easier and easier to spend what's left over after you pay taxes. And so one of the things that does also affect affordability is exactly what Nick was just talking about. We get used to a certain quality of life that is dependent on a certain threshold of convenience, and that costs money. That cost a larger portion of our take-home pay than it used to. When I used to have to go and do X, Y, and Z because I couldn't pay an extra 20% to have it come to me, I had 20% more money in the bank. And when you take in the inflation and asset prices, the lending side, even leave that alone, but a very stagnated wage level right now, and the fact that we're just blowing money on Fortnite skins and burritos that are getting delivered to our door, it's difficult to imagine prices not having to move, or us, like I started this diatribe with, not having to significantly alter what we have come to know as our quality of life that we want to protect. It's not doom and gloom to me. I don't say these things like I'm coming from a place of fear. This is the reality, though, and it's a very interesting conversation. It's one of the same reasons I keep saying I don't think we've ever experienced a moment in time like this at all.
Yeah, no, I agree, and I also, there's part of me, it's the same when we went through COVID in that market, is that logically we're like, this can't happen, this can't happen, this can't happen, and guess what? It continued to happen. A bunch of
stuff started happening,
right? And so I always tell people is like, when we're listening to this, and a lot of this is logic kind of conversations and basing it off of previous history and experience and trying to cast a vision forward. Mm-hmm. And, I don't think that we can, accurately say, all right, this is going to happen. We can give our opinions here and say it should come down, right? And this and this and this should happen. But, what we can look at is that right now, moving into kind of the Fed talk and Fed rate cut, is there's this kind of roller coaster of, is the Fed going to cut rates or are they not?
Yeah.
And if they are going to cut rates, by how much? And if they only cut by this amount, then it's not going to have much of an impact in a positive way.
I think you're going to see a half point in September. I think the market has largely baked it in, but you're probably going to get 2 or 3 really strong days after that happens, just on the euphoria of it all.
So originally,
that does to treasuries, though, I don't know that it'll have the first rate cut, I don't know that that'll have a huge impact on treasuries.
So here's what I think happens is, I agree. I think we go to realistically, they were saying only a 25 basis point cut, right? And even Mortgage Mike, when he was sharing with our team, he's like, if they only cut by 25 basis points, then we don't. In fact, we probably see worse pricing when it comes to mortgages, because we've already built that into our costs and anticipation and excitement. So we've already, it's kind of it's the pre-appetizer to the appetizer and meal coming out. And now you've just gorged yourself on that and you're full.
To get more specific around it, right? Like a mortgage company is going to make money on the difference between the spread by which they're borrowing money and the spread and that they're lending it at, right? And so it's a competitive market. If you believe that treasury yields are going to drop, then your spread is going to increase, and you have the ability to shrink that margin so that you are offering mortgages at a lower rate than the next guy. And so if you're a savvy mortgage, company, you're going to go, hey, we think there's going to be a half point drop next month. That should bring treasuries down. We're going to go ahead and start slimming our margins down now to capture a whole bunch of business. And then, we're going to get that business before anybody else. If that doesn't happen, all of a sudden rates aren't going to move. You could see a 25-point drop in the Fed overnight, or the Fed lending rate, and mortgage rates actually go up.
Yeah,
because they'll be like, oh, we anticipated a 50% or a 50-point drop,
which is just going to take consumer sentiment and just stick its head further in the toilet. Right. It's because that's my one concern.
If they cut a quarter point and rates go up, buyers are going to.
That's what I'm saying is it's gonna feel like a takeaway at that point. And not saying that people are going to leave the market, but it's certainly going to lead to more conversations as you're already moving into Q4, and people naturally have it's the holidays kind of feel. Now you're fighting this uphill battle against this disappointment around rates with nothing really on the horizon in 2024 that's exciting at all.
Here's I shared this on our team meeting this past Tuesday. And I always tell people, I said, what we know in real estate, the average consumer doesn't. And we assume that they do know. We make an assumption on this. And when we look at the average, when we just look at consumers as a whole, they think the Fed interest rate is directly correlated with the mortgage interest rate. So, a 50 basis point cut, while it could be great, we also have to understand that means bad stuff has happened to get to there. Where everyone, you see on social media, like, we need the rate cut, 50 basis point. And there's other people who understand this at a much greater level than probably any of us. Like, no, that's bad. Right? That could spur continued run on inflation, right? It means that we're losing more and more jobs. And we got to have, if you're going to have a buyer, they have to have a job in order to qualify. But your buyers that are stable and secure and confident, they are going to look at this 50 basis point cut. Any interest rate cut, in my opinion, they're going to tie that directly to mortgages and come out of the, and we'll see an initial boost. And it's going to be the ones that feel the need to buy, not the want. The need to buy, need to sell is where is the playground we are on in this type of real estate cycle
100%.
and market.
Yep.
Right. In 2021, during the COVID market, this was, man, if I could get,
throw it on the market, see what happens.
If I can get this or even more, then that was the make me move price.
Yeah.
And buyers were wanting to get out of the crap hole that they were in, or to get out to the country, or to have more space, so that, because they were on top of each other. The lockdown, there was a want and a need for that. Now you're seeing people that are selling, that own their home since COVID. And you're like, why are you selling? Either it is they're back in the office and the drive is horrendous.
We don't take that into account enough. Just how many people over anticipated this work from home situation. Like, I'm going to move all the way over here and take all this money. And now it's like, no, you got to come back to where the humans are to come back to work now.
There's definitely
no
an
more
element
remote
of that.
working for you.
Yes. Now you have insurance and property taxes that have gone sky high and running rampant. Right now, the massive problem that we have is it's not property taxes anymore. We will see that as a plateau. We'll see that really slowing because we're not seeing the massive value increase. It's now going to be that slow increase burn, or we might see a little bit of a dip. I've heard
protesting your taxes again.
Yes.
I had a dip this year up in
Absolutely.
Denison.
Yeah. So we've seen dips in that. The problem is where you're not having the dip is you're having an increase in your property insurance. Yeah. And as a real estate professional, this is where I don't know from a legal liability that if you might be throwing out something or giving some type of pricing range in terms of what you believe the monthly payment should be, and you don't have and understand property insurance at a high enough level. My house right now, and the one I currently own, went from $2,800 and then it went to like $4,000. It's now a little under $10,000.
What?
Yes. And it's for 3,000 square foot house worth $575 to $600.
That's bananas.
Yeah.
Yeah. I never really thought about the implications of taking those calculators seriously and making sure that they're accurate. That is a whole, this kind of goes back to my thesis that prices at least need to stagnate, if not come down. We're just talking about another variable that makes things very difficult. My hope with the insurance market, that piece of this, is that's enough of a capitalistic market that competition has to win. Yeah, competition has to win out over time. You're not going to see taxes come down very often. You might one year you get a downward revision. That's not going to become the norm. If people simply can't afford the insurance on their homes, there's an opportunity to move in and undercut the market. That should fill itself over time. There's going to have to be a movement where, unfortunately, maybe, your elderly generation population start to lose their houses, or, they become in such disrepair because they had to pay their tax and insurance bill. And now they're selling this just because they can't afford it anymore, or taking out predatory loans to pay this off in order to stay in their home. And so there's going to have to be something. Look, it's a good point.
I'm not always for government sticking their hands in there, but when in this moment there has to be at least a supervised vision, visits where the government comes in and is like, hey, what's going on here? And making sure that insurance providers, if they're going to play in a profitable, like in a capitalistic market, I get it. But at the same time, you can't just pull out. You can't just drop people. You can't just say, this is the rate, because now if you're dumb enough to pay it, then we'll just go ahead and insure you this way. We're starting to see, at least here in Texas, we're starting to see where they're not even, some of them not even willing to cover like wind, hail, and storm damage to roofs, or they're depreciating so much over time that they're only willing to pay out X. And it's like,
I've seen that happen a couple of times.
So if that's the case, you're still paying a high dollar amount, and you don't understand it's at a high level and think your roof is covered. And then all of a sudden you have to go replace your roof. And now you're out thousands to tens of thousands of dollars that you didn't budget for.
Yeah, it is interesting that market hasn't already corrected itself, because this has been a few years. I don't understand the insurance market well enough to know why it hasn't, meaning there is still regulatory components of it, meaning you won't get lending without insurance.
Is it corrupt?
I mean, I don't want to come out and say it. I'm surprised.
Built into the process.
Yeah, I'm surprised that it didn't correct itself already. You're talking about a required product. An interesting thing, you just made a very interesting point, though. Your home that you're moving out of now, that increase from 2,800 to 10,000, that's an increase of, essentially $700 a month or something like that over the course of a few years. If you bought that home, let's just say you bought that home in 2010. I don't really remember when you bought it. What percentage of your mortgage payment would that increase have been right now? I mean, if you had bought that same home in 2010, I can't imagine that your total mortgage payment couldn't have been more than like $2,100.
Yeah.
And so if you have a $700 increase, the point that I'm making is, how many of those people, that demographic that you just mentioned of, I just can't afford my house anymore, how many of those same people are in that same baby boomer category where they're like, it's now or never, we've got to sell, because now not only is our entire nest egg tied up in this house, we can't afford the insurance and property tax payments. They're eating away at our nest egg. We need to liquidate and go move to a smaller, more affordable place that we're renting or something. And if that starts to happen nationally, do the floodgates open to a huge amount of inventory?
Let me ask you
and
this.
does that drive prices down that way?
Yeah. So I'm looking at my policy, right? So my policy is it's $9,849 annually, right? So a little under 10,000. I was getting quotes because I might turn mine into a short-term rental or mid-term rental. You want to know what that cost is?
Oh my God.
Do you think it's higher or lower?
I mean, I'm going to say higher, but
no, $6,104.
What?
So they trust somebody else to live in your house for one night more than they trust you to live there permanently.
By a percentage
From
of
a
about
risk
33.
Yeah.
It's ridiculous.
So obviously there's problems in that insurance marketplace.
Yes.
Is insurance setting themselves up almost like lending did in 2008, just to be so overregulated that they can't even sneeze without, like, I mean, it just seems like when you're moving that quickly and that definitively and that brazenly, that you're setting yourself up to, like, for people to finally have enough, And maybe that's not what triggered 2008.
Mathematically, I mean, right?
Yeah.
That's one of the reasons I'm surprised that it hasn't been corrected. And I don't know enough about, like I said, I don't know enough about the markets to understand how this type of obvious, it seems to me obvious, money grab is working, because it feels like in any sort of capitalistic market that involves millions of people a year, a solution is usually provided in the form of competition, meaning where there can be a race to the bottom, the same product or same service at a streamlined price. That almost always happens, almost always in every single market. And the reason that it hasn't in insurance is beyond me. But when that doesn't happen, and you bring in the element that is basically a required product, a required service that I have to pay for, that speaks corruption to me in bold red letters.
Well, you said it. It feels like somebody should have noticed. It's crazy.
Just that's you. If you didn't have insurance, how many years out of the years that you've owned your home would you have spent $10,000 out of pocket on repairs?
None of it.
Not even
I mean,
close. I can't even imagine.
I think in 2020, I may have, or 19, I replaced the roof, and I mean, I've had other help. Like again, the roof would cost me probably $10,000 or $12,000 right now,
and then it would be replaced for 7 years, and you'd be good.
I mean, maybe it needs to come down to if you set up a certain fund account that you become self-funded, and you have a high like medical insurance where you have a high deductible plan that may cover flood, right, and other things. But I mean, for the majority, look, what do most people use their insurance on? Typically, it's roofs.
Yeah,
right?
definitely
it's hail damage,
Right.
wind damage, some type of storm damage that happened to the roof, the gutters, the fence, and stuff like that. Doesn't cover foundation. Hardly covers any type of plumbing unless you have a massive flood.
Right.
Yep.
And so I think ultimately that's where I think that's the straw that breaks the camel back in this, and saying that there needs to be a control on that.
Yeah.
And it's probably coming. It has to come.
I think it would be helpful. I want to shift gears because there's another component of this that I think is very interesting. We talk about the rise to build to rent communities. So this is becoming much more and more popular. If you look at the North Texas suburbs, there's entire single family residential communities popping up that are all for rent. The developer is going to hold on to them or liquidate them to an institutional investor who's going to hold them and rent them out. They're never going to be for sale. At least that's not the game plan. Going back to that statistic around families in Dallas that 70% of them owned homes that they made between 100 and 150 to only 50%. My brain also goes to how many of those people are of the same mindset of we're going to sell now while prices are high and we're going to wait for prices to come down and we're going to rent for a while. That's surely a substantial amount of them. And then the reality also becomes the longer that you rent waiting for prices to come down,
the longer you are renting.
And then also you're driving the demand on the rent side, and rents will go up as well.
Yes.
That's a huge we have about in I don't want to get the numbers wrong, tens of thousands of units coming online, and this is the apartment side, but I think it probably is mirrored on the single family side as well. Tens of thousands of units coming online for Class A apartment complexes here in the next 12 to 18 months in North Texas. But behind that, there's building permits for new units are at an all-time low, because as soon as rates started to get hiked up in 2022, people were like, stuff's too expensive. I'm not borrowing at this rate. I'm not going into the new development space. So once all that inventory is absorbed, rents for Class A apartment complexes at least should continue to go up in North Texas. If we do the same thing with build to rent communities on the single family side, we'd have this whole demographic of people that are selling their home, waiting for the right time for rates to come down or prices to come down or whatever. We're going to move into these build to rent communities. And really all that's going to do is drive those rental prices up. And I'm wondering how that's going to affect the purchase market. If so many people are going to start to become renters and rents go up so much, what will happen with home prices? Will they become more affordable or not? It's a really interesting conversation, especially when you take into account that a lot of those same baby boomers that are going to sell are going to be the ones moving to those build to rent communities.
And does it push people towards the trend, which a lot of this feels like, where we're just not going to see, we might see this old school resurrection of living in your house for 7 to 10 years, right?
Yeah.
We've seen people moving so much just in my 12-year career in real estate. I've seen many people move many times.
Yeah.
And it was a pretty normal thing to do, I think, up until somewhat recently, for people to do that since the recession. And are we just going to see this move towards people buying homes and then staying in them longer term?
And that's always the way out of any of these types of quagmires, is the longer you stay in an asset that is of limited supply, the more that it will eventually be worth. And so I think at the end of the day, you're right. Like the way forward may be a choppy few years in the purchase market, but essentially people just staying put for longer, as, by the way, was always the American dream.
Yeah.
The American dream back in the 50s was never advertised as buy a home and sell it in 4 years.
Yeah, buy this house, live in it while you remodel it, and then flip it and move out onto the next one.
It was buy a home.
Yeah.
That was the dream.
Yeah.
And so we definitely ran away with that when money became very cheap. I think you might have hit the nail on the head. You might see people staying put for much longer, having these generational homes, as was the norm for a very long time.
Yeah.
But we saw, I mean, right after the recession, it went from 5 to 7 years to 7 to 10, right? And then it sped up because of COVID, right? And we started to see that. And then ultimately the thought process is now, because they paid the type of price they did pay, was it going to be 10 to 12 years was where we're going to start seeing the average. And then if that's the case, then we start taking where we would have an inventory problem right now, because it's harder to get more people to convince to sell. And then, as we wrap this up, one of the things that we are seeing here in North Texas, in the Dallas-Fort Worth area, is that, when it comes to inventory levels in the first place, historically they say, balance market is 6 months. Right. And as we break this down, we've seen here, but it's about 4 months is kind of our sticking point. So the real test will be, as we continue to climb past this 4 months, how much pressure will it be put on the pricing demand that we talked about earlier? And then ultimately, what does it do to the overall market?
Yeah.
Does this discourage people from putting their homes on the market? Do we see these homes that are currently up for sale? Do they just get discouraged and they take their home off, and then we have a massive decrease in that, and then we start to have that drop in interest rate, and then we see a rush in demand of home buyers, which could lead to a temporary false sense of hope and security about massive multiple bidding war opportunities, and we're seeing a spike in pricing again temporarily. It gives everyone this false security that we're over something.
Isn't it crazy that on both ends of the spectrum of the market, taking listings will be hard? When anybody can sell a house because they're all getting 110%, taking a listing is hard. What are you going to do for me that other agents, this market's selling the house? When nobody's house can sell and inventory's through the roof, it's, what are you going to be able to do for me to get this freaking house sold? On both ends, it's a difficult problem to overcome, is like why you should select me as an agent to help you get your home sold. And Jesse just flashed something up, but being able to see exactly and explain market trends and have the types of conversations we're having today is the exact way that you're going to be able to separate yourself from other agents in that type of market.
When it comes down to it, no matter what happens with prices, no matter what the news or anybody else wants you to think is doom and gloom for real estate agents, the ones that understand this market, the ones that understand their value and can articulate it, are always going to do well. I feel like I sometimes sound like I'm just doom and gloom on this podcast. I just think we're at a very unique moment in history, and we do ourselves no favors by turning away from it and pretending like it's not there. But we know people that were absolutely crushing it during the Great Recession. They pivoted, they had the right conversations, and their businesses thrive. So don't let me stop you in your mindset for thinking that you can go build whatever business you want to right now.
And again, as it's, to me, the listing business is the one to be in.
Yep.
Right. I do believe there's an opportunity on the buy side, and we can get into it. I also believe that this new era of real estate, unfortunately, is going to cost sellers more money. That's a whole different conversation for probably a different day once we get past this, kind of lawsuit talk. But ultimately, I think the cost to buy and sell a home has increased temporarily. Yep. We'll see what compression comes from it. We'll see how it has an impact on the inventory market. And ultimately, what we do need to happen is we've got to have a stabilization, right? We're ping-ponging back and forth at a speed that's not good.
People need to get their bearings with it too.
Yeah.
Like Brian has said this on previous episodes. People will adjust to anything given enough time. Nothing can settle in right now, so it doesn't feel like it doesn't feel stable. And I think that's what's keeping more people on the sidelines than anything.
If you go back and listen to, was it last year's episode or 2022 when we had on Armando Montalongo for the second time?
That was early 23. It didn't feel like 2 years ago.
Yeah. I would go search for Armando Montalongo's talk. And
second episode.
The second one. The first one was good. The second one was better.
Yeah.
And Armando kind of was bringing up some more doom and gloom style, but it's all about looking where the puck is going and where the opportunity is.
Yep.
And it's the same thing here, is like people will buy and sell houses.
Yep.
Doesn't matter how bad the market's going to go. You heard about in the 80s and 90s, interest rates were 18%. People still bought and sold houses. Now, they're like, oh, homes were more affordable. Sure, but it's all relative.
18% is pretty high.
Yeah,
still.
it's all relative, right?
Yeah.
Like, income was a lot lower then. I know back then my parents were making less than $10,000 a year salary.
Yeah.
I think it was like 8 or 9.
Yeah.
So like everything is relative when we look at the good old days of the past, or we're trying to compare the past to the present. And ultimately, we are still looking at a how the election is going to shape up.
Yeah.
We are on an election year. Election years, in my opinion, always get a little wonky with the way the real estate market, the interest rate market, and the economy is going to go. We're trying to predict if this person wins, this is going to happen. If this person loses, that's going to happen, so on and so forth. So go look at the episode. Armando Montalongo.
It's not before episode 100.
Armando Montalongo is
Didn't do a good job of tagging that one.
Yeah, it was 2 years ago. We'll have it up here and
165.
Yeah,
Okay, there you go. Yeah.
160,
88 and 165.
Yep. So 165. That was 1 year ago.
We didn't even put his face on.
We probably should have done that.
Probably should have done that.
Yeah, we just have Matt and Brian's face on that. Yeah,
Jesse and I were talking about thumbnails today. We haven't quite figured that out yet.
yeah. We take the easy way on that one. So, if you like today's episode, all you need to do is go and hit that subscribe button on YouTube. Look up It's Only RE Pod, as well as go to our Facebook group, the only real estate group worth being a part of. And then smash the 5-star buttons on Spotify and Apple Podcasts. And then go love our sponsors, Mortgage Mike, mmgloans.com for that Mortgage Mike stamp of approval. Then you've got the best home warranty company out there, which is Armadillo Home Warranty, armadillo.1/TOR, TORE. And then you got Dana Wynn, Dallas-Fort Worth property manager. The only one to call and use is Dana Wynn, homeward@dfw.com. And then Jesse at Tor Studios. Maybe you should go check out torstudios.com. Maybe not.
Tor Studios currently has a sponsorship option available for a YouTube specialist. If you would like some free airtime and free advertising, you know what you're doing on YouTube, reach out to me or Jesse, and we'll get something figured out.
There you go.
Because we need to work on our thumbnails.
Yeah. We got thumbnails and description. That's not Tor Studios can make you look good, sound good, and make you feel good.
Tor Studios has got some awesome clients with a lot of views that could be beneficial to somebody who's trying to get their YouTube business out there. We got
very true.
You help us, we'll help you type of situation going on here.
True.
Absolutely. We'll see you on episode 231.
Reach out. Bye. Hit the button. I went too
I'm
fast.
just going to hit a button.
Hit that one right there.
That's
Billionaire idea. End this with the billionaire idea.
Oh man, I wish I had.
And now, Brian Force's billionaire movie something.